continue with IAS 16, IAS 12, IAS 38, IAS 36, IAS 37, IAS 38, and then also IFRS 15, revenue from contract with customers, and then, okay, let me just take this out. I'm looking at the core. So these core accounting standards, I believe that you are, by now, should be okay with them. Now, when you are learning IAS 16, it means that along the line, IAS 40 will come on, investment property. Along the line, IAS 20 will come on, government grant. Along the line, IAS 23, borrowing cost will come on. Because all of these accounting standards are closely related to IAS 16. Then, along IAS 16, IFRS 5, asset held for sale and discontinued operation. So, tell me, what do you say? Are you strong? These are the core accounting standards. Are you strong with these standards?
I think my little problem is with the 40.
IAS 40, okay.
That's the investment.
No, yeah, that's investment property. Okay.
I don't get a concept of.
Okay. Okay. Only that. Okay. You're okay with everything?
Only the 12. The 12.
Tax.
Yes.
You still don't get a tax.
Tax.
Uh-huh.
Looking at some questions. The deferred tax on the share-based payment, that one.
You get it?
Is okay, yes. But the deferred tax, fair value, like there are a lot of things inside. Maybe unless it's not necessary.
What question were you looking at?
It's in the book, the IC.
Okay, so how do you have it here?
No, I don't have it here.
So how was the question? Maybe if I see the question, then I can explain to you why the treatment was so. Because generally when it comes to deferred tax, as we mentioned earlier, you're going to look at the carrying value of the asset and look at the tax base.
Determine the tax base. Some of them, they are financial assets, receivables and those things. So
yes.
Determine the tax base. Some of them it has to be zero. Some of them it has to
yes.
be the figure itself.
Yes. Something like looking at how you carry financial instruments. When you look at a financial instrument, that's what we are about to do. It includes buying of, let's say, shares in a company. It's a financial instrument. Buying debentures. It's a financial instrument. Buying loan notes. It's a financial instrument. Now, when you buy these loan stocks, they are all financial instruments in the form of what? Investment. So if they are investment, the question is, how do you carry out this for tax purposes in the financial statements? The first thing is that, as you know all the time, these are investments. So the tax base of these will be the cost of those investments. That will be the tax base. But for accounting purposes, the carrying value of these things will become what? Different. Why? Because for instance, let's say Ken buys shares in Corn PLC at $2.5 per share. If they buy 1,500 shares, so this is the concept. So Ken buys 1,005 shares at what? 2.5. Look at what is happening for accounting purposes. This is under financial instruments, which I'll be doing in a moment. But let me talk about it so that I link it to the deferred tax. This is how much you bought. But you see, for accounting purposes, at the year end, we would have to ask ourselves, is the shares in Corn PLC still 2.5? So when we bought it, what is the cost of our investment?
2.5 times 5.
Yeah?
3750.
3750. So this is how much we paid. Now remember we bought shares, so it's an investment. So the double entry for this is that we're going to debit our investment account. It could be investment, it could be the shares account, or that will be 3750. Then we credit what? Cash or bank. Maybe we wire the transfer through our bank. This is recognition. But at the year end, we would have to ask ourselves whether the share price in Con PLC is still this amount. So the year end, that is called measurement. So the year end, you will be told that the year end share price increased to $3.25 per share. So what is happening? When you bought the shares, it was what? 2.5. Now it is 3.25. So for the year end, your investment is now
4875.
so 3.25 by 1,500, 4,875. Look at it. You will see that there is what? An increment. So find the difference for me.
1125.
So 3750, $1125. This increment, how do you treat it in the financial statement? Now, it's an investment. Sometimes it has to be treated to surplus account. So what we do is that we debit the investment account, investment in relation to this share with that figure, 1125, and then what? We credit surplus 1125. Now, there are two things.
So this one will be in the income statement, the credit.
The credits?
Yes.
No, the credit will go to statement of changes in equity.
So let's go to reserve.
Reserves. But there are two things. If these shares, we bought it to sell it for trading purposes, then this surplus will go to the income statement after other comprehensive income. Are you getting the idea?
That becomes an investment, something else.
Yeah, that will become investment for trading purposes. But if we didn't buy it for trading purposes but held to maturity, that means we are just holding the investment till we don't even know the time. Then whatever gain or loss we make will go to the surplus account straight up. Are you getting the treatment here? Now look at it. So at the end of the first year, your investment in your books is this figure, 4875. But the question is, how is the tax authority valuing your shares? The tax authority still knows your shares as the cost of your investment, which is what? 3,750. Because the tax authority is not interested in this profit you are recognizing. They are waiting. When you sell the shares and you make any profit, then they charge what? Tax. So if you look at it, the tax base will still be the cost of what? The investment. So the difference, which is this 1125, becomes your temporary what? Difference. Meaning that if you should sell these shares today, you're going to be making what? Profit. For that reason, you have to make provision for deferred tax. And that is a deferred tax liability. So in that case, if the tax rate, I didn't bring it, but if the tax rate is let's say 25%, then your DT liability will be 25% of 1125. What do we have?
281.25.
So this is where you debit your income statement and then credit your income tax account. That is it. So in each scenario, you are looking at what happened in the first day and how should we carry it. But issues about trade receivables, trade payables, the tax authority doesn't know about those things. So you sold goods to somebody and then it is only when we are looking at tax. Remember I told you corporate reporting is closely related to tax. So sometimes there will be a corporate reporting question and the examiner will ask it in tax. For instance, You sold goods to customers, a customer, and you charge VAT on the goods. Then it means that you sold the goods at what? A VAT inclusive price. Now the customer has been declared bankrupt. What is the tax implication of that?
Tax will suffer.
So what do we do? This is a question the examiner can pull up in tax. So it's a trade receivable, you charge VAT, and so claiming that you have collected VAT, so you are a registered VAT agent, and you are going to remit that towards the registrar general, sorry, the commissioner general. But now that customer has been declared bankrupt. So what do? It means you have to what? Reverse that transaction and add a note to your returns, proving that that customer whose VAT is say 2,000 Ghana cedis has not been what? Received because he has been declared bankrupt. So when it comes to receivables as an item, for instance, you are carrying it in your book, carrying value, but the tax base of receivables is zero. Because the tax authority in their book, they don't have anything called receivables. So if the tax base is zero, then that means that your carrying value is what? Your carrying value is going to be the trade receivables, but the tax base will be zero.
So there will not be tax on it.
If you look at the carrying value, it's, let's say it's 2,000, okay? But the tax base is zero. That means there is a temporary difference of what? 2,000. Are you getting the idea? And you can make provision for deferred tax on it. So it depends on the scenario. That is why I know the questions you are going through. I've seen the questions you are trying to solve. These are scenario questions, and you have to understand the concepts that are establishing those ideas.
So the concept is, you first look at the recognition criteria. That's the time the asset was acquired, and
or the transaction took place.
Up to the end of the accounting period.
Accounting period and the discussion.
If there is any change, then you can make provisions.
You can make provision for the deferred tax. So that is what you have to understand about that. Then investment property. What did you say? You said the concept. Now the idea about investment property is very simple. Now, when we are accounting for non-current assets, there are basically two accounting standards that we can borrow. The first one is IAS 16 and the second one is IAS 40. Now, we will use IAS 16 to account for the asset if the asset is used for business purposes. In other words, we are using the asset to generate our revenue for our organization. But sometimes companies acquire assets, companies lease assets, and they are not leasing or acquiring the assets for business purposes, but they are leasing or acquiring the assets for capital appreciation because they want to sell it later on in the future, or for rental purposes. In that case, when the asset is for capital appreciation or rental purposes, like you buy a land today, then the business buys land and they just have the land, they have not developed the land for anything. That land is not used for business purposes, so that land will be accounted for according to what? IAS 40. So if the objective is not for business purposes, then it will be accounted for according to IAS 40. So either capital appreciation or rental purposes, then it means that it is IAS 40. Now, if that happens, under IAS 16, because it's for business purposes, we need to what? Depreciate. But when we are carrying it for capital appreciation or rental purposes, we don't depreciate the assets. Rather, we must carry the asset at its what? Fair value all the time in the financial statement. This is where at the end of each year, we will test for what? Impairment.
So, all right. So assuming a business entity acquires a land, and the purpose of the land is not determined now.
Yeah.
But it's carrying some value because they acquired it at a cost.
Yes.
At the end of the year, how do you account for it?
It will still be according to IAS 40.
Oh, okay.
Are you getting it? Because yes, it's not for rental purpose, but if you have not determined the thing, indirectly it's for capital appreciation. So that is the idea. That's the idea. So for the investment property, it means the carrying value of the asset in our balance sheet is going to be the fair value at the end of the year, its value minus any impairment that the asset has suffered. That is how we get a carrying value. But in IAS 16, carrying value equals your cost minus your dip. And the dip can be using any of the methods, straight line or reducing balance. So that is a concept under IAS 40. That's a foundational concept.
So, okay, so the carrying value of the assets and then the fair value. So the IAS 16 assets are treated under the cost minus depreciation. Then this one is the fair value minus impairment.
Because in IAS 40, it's like we are using the fair value revaluation module. So we are always looking at the fair value of the assets. Then the third thing you need to understand about the relationship between these guys is the movement. In the level 3, the examiner can mess up your mind in relation to that. So an asset is used for business purposes, then during the year it's switched over into an investment property. Or an asset was used as an investment property or for rental purposes, but during the year the business stops the rentals and switches up to IAS 16. So you need to understand how those movements work. And it's not a big deal. When those movements comes in, all you do is, assuming it is for business purposes and now they are using it for rental purposes, you just calculate the carrying value as at that date that the decision was what? Made. So, as at that date, what is the carrying value of the asset? It will be the cost minus your accumulated depreciation. So once you get a carrying value as at the date that the decision was made, then you ask yourself, what value did they say they want to carry the asset at? So let's put in some figures to make it more reasonable. Let's say at the date that the company made a decision to carry or to change the asset into an investment property, the asset had a carrying value of say 18.5 million. But when they converted the asset into an investment property for rental purposes, they said that the fair value of the asset is say 21.5 million. What is happening here? It means upon the conversion, there is going to be what? Revaluation what? Surplus. So that difference, we strike it out, $3 million will go to the revaluation surplus account. So we're going to be debiting the asset account under discussion with the $3 million, and then we credit the revaluation surplus with the $3 million. Then, from the time that the switch was done, up till the year ended, get the idea well. Now, maybe let me try to just put in some years to make this thing well for you. Let's say that our year ended is, let's say 31st October. And then we made the switch. We made the switch from business purposes, BP, to rental purposes, RP. Then we made the switch on 1st July. But our year ended is what? 31st October. So you will see that at the day that we made the switch till the year ended 31st October, there is some what? Gap. So you will see that the examiner may tell you that at the year ended, the fair value of the assets was valued to be, say, $20.5 million. What do you think is happening here? When you did the conversion, there was a revaluation surplus. But the difference between the dates that the conversion till the year ended, there has been a new valuation. Now, if you look at this value and this value, what do you see? It has reduced, right? By how much? 1.5 million. Sorry, 1 million. This 1 million, how do you account for it in the current year financial statement?
the year end, this is the actual value.
That's right, of the investment property.
Yes.
But as at the time of conversion, this was the value. So how do you account for this 1 million?
This is not impairment.
Impairment, that's correct. So how do you account for impairment? Debit, Ebazi. Debit, P&L, so income statement with the 1 million, and then you credit what? The asset account. That's it. Do you see the switch? So this is revaluation surplus, but this is what? Impairment loss. So you got to get a difference.
So you see that they are giving you about three scenarios. Yeah. Moving from the IAS 16 to 40, they gave you two values. When the asset was acquired and when it was transferred. To the,
investment property.
Investment, they give you. And then at the end of the year, they are telling you that the asset, the fair value is now 20.5.
So what is the effect?
So from that July to 31st, the asset has impaired.
In the
financial statement. Yes, sometimes they will say if the company uses cost model or revaluation model, the treatment differs. That when it's moving, we are using it as PPE, and I want to now start using it as investment property, we rent it out. But we are using cost model, that is our policy. And the cost model of the IS16 says that you should treat assets as a cost less accumulated depreciation. Right. So since you have moved it to investment property and you are using cost model, should you have to go ahead and depreciate it?
This is the second time you're asking that question, right?
And I think it's against the principle.
It's against the principle. Because once it is for investment property, it doesn't have to be depreciated. You have to get this thing and just convince yourself that this is how it should be. I hope you are getting it. Because it doesn't matter the method we are using. Once we switch to an investment property, we can't depreciate it. It's not for business purposes. How do I rent a room for you, then I say I'm depreciating the rent? Sorry, the building. Are you getting the idea? Because it's for investment purposes. It's for investment purposes. So I'm not going to be depreciating the asset. Rather, I'm going to be treating what? Issues in relation to impairments.
Okay, so should I transfer it at the carrying value and stop depreciating it? Because
yes.
My policy is not revaluation.
Okay. The transfer.
Yes.
Yes, you transfer at the carrying value, depending on the company's policy. But if it is the carrying value that they are transferring, then they transfer. Because usually, investment property should be held at, how do we call it? Fair value. At fair value.
So then why does the book is wrong? Because that's what it is in the book. That when you are transferred, they say cost model, and cost model means this. And now, and they also define that the investment property is like, you shouldn't depreciate, as you are saying. Mm-hmm. So you can't depreciate. But if they are now saying that if I'm under the cost model and I'm transferring, I have to use the cost model under IAS 16, then
there's a conflicting thing there.
Maybe you are not.
It's in the book. Have you seen it?
No, I'm not. I'm not.
My corporate reporting book.
So maybe next week when you come, you can bring it. Yes. Then I can clear that up.
We see you the level 2 book and the level 3.
Maybe we can clear that up. But sometimes it's like that. You see, it's not that the standards are conflicting, but there are clauses in the standards but it's not conflicting. It's like reading the Bible. Sometimes you read a story somewhere and you go and read another thing somewhere. You're like, what are they saying? Is it not conflicting? No, it's the context. So maybe there is something there that we can look out for and then clarify it.
So the principle still stands that when asset is carried out as an investment property, the listing should be fair.
So it means it should always be transferred at fair value.
It depends on the organization's policy.
So what's the other option?
They can say they will transfer it at the carrying value, but not depreciate. Are you getting the idea? But the concept is it should be carried at fair value. That is why after the transfer, they would always test for impairment for the year ended, or they will revalue it for the year ended. Okay. Now, when they revalue and the figure is bigger, then the difference will still go to what? Revaluation surplus. But if the figure is smaller, That is where it is what? An impairment. IAS 36, IAS 38. You remember when the recoverable amount of an asset is greater than the carrying value, we call it what? Revaluation. So that's the idea.
Okay, and the treatment too of the increases and the decreases.
Yeah.
Does it change when it's either under the revaluation or the other model? As in, so when there is an increase or decrease after you've transferred,
Okay.
when there are maybe losses and gains, will it differ?
Like this scenario.
Yes.
Like this scenario.
Yes.
After we treat it like this,
Yes.
between July to October, it has now been valued like this. And you are asking, would the
So if now it is, let's say, business PPE, you are sending to investment property, and now there is a downward revaluation. We are saying it goes to P&L.
Yes.
So what if it is from investment property to PPE?
That's right. From investment property to PPE, investment property to PPE. So let's just flip over that point. So when we are flipping over, let's say an investment property was carried at, as at the time of the conversion, was carried at whatever, $50 million. Then it has now been converted to what? Business purposes. So rental purposes. And so they carried it at the fair value and claimed that the economic useful life of the asset should be whatever amount, maybe 10 years. So that right now, they will depreciate the asset. Year again, year will come in. Our year ended is October 31st. Let's say we made this switch on 1st February. So for the year ended October 31st, how many months do we have there? Feb, March, April, May, June, July, August.
8 months.
September, October, November. Hey, the term crowd was it 8 months? Okay. 8 months. So depreciation for that year will be 15 mil over what? 10 by 8. You mean 9? Hey.
Sorry, 9 rather.
Is it 9?
January to October is 10.
It's first February.
First February. So it will be 9, right? So 9 over 12.
12, yes.
So can I have an answer for this? For the depreciation? $1.125. This is the depreciation for the year ended. But the company, as at the year ended, want to carry this property at, so what is the carrying value at the year ended? 15 mil minus 1.125.
Yes.
What do we have?
13.875.
So look at it. This is the carrying value as at 31st October. But the company has decided that they will carry the asset, so they revalue the asset and will carry it at the fair value of, say, 14.5 million. The question is, this is a revaluation of surplus. So we strike out the difference. What's the difference? No point.
625.
So this $0.625, we debit the asset account, 0.625, and then credit what? Revaluation surplus, 0.625. So if there is a switch like that.
Oh, so the company can make a specific policy that the asset under the IS 16 is carried at fair value.
Yes, because revaluation, if we are using the revaluation model,
Okay.
are you getting it? If you are using the revaluation model, at the end of the year, the standard requires that we should what? Revalue the asset. So if they revalue the asset, they will say that it is now what? 14.5. That is where revaluation surplus will come in, or revaluation loss comes in. So in this case,
So when the lesson comes in, what you were saying.
Yes. So Nhyira, so this one we had a loss.
no, we had a profit, right? The fair value is bigger than the carrying amount. So it's
so you see where you've drawn the arrow.
Yeah.
At that point when
we were transferring.
So if let's say the fair value was this. Now when we transfer 15, then when you transfer maybe you realize that it was 12.
Okay.
So if there is a loss at that side, before we even do the first equation.
Yeah. How do we treat that?
Yes.
Is that your question? Okay. So let's say that this guy was 15, but we brought it here as what? 12 million. Okay. That is a reduction in the value of the assets. Once there is a reduction in the value of the assets, what do? We have to debit. Sorry, we have to.
The assets.
We would then credit the asset with the difference. Let's say 3 million. Are you getting it? Then we're going to debit. That's a loss.
Yes.
Upon the conversion. So it can go to the income statement for that year ended. Upon that conversion.
Then it means the same thing.
The same flipper.
Oh, okay.
The same flipper. So it's about understanding what is happening in this given scenario and asking what must I do under this scenario. Are you getting the treatment?
Yes.
So that is the movement. So that's the movement. So that is what you have to understand about IAS 16, IAS 40. Okay.
So the IAS 40, the concept is always carry the risk at the end of the year at fair value.
At fair value.
So we test for impairment.
Impairment, that's the key word. So if the fair value is more than the amount at the beginning of the year, then it becomes revaluation note, surplus. If it is less, then we test for it means impairment and we have to write it down. So that's it about that. All right, so let's look at financial instruments. Three different accounting standards for just one concept. And in corporate reporting, all of these standards, the examiner has asked questions on them. But as I told you, it's one of the areas that the examiner asks questions on. Even in audit and assurance, the examiner has asked questions around financial instruments.
So this thing will come off it.
Yeah, it's one of the standards that is very common. So IAS 38 looks at recognition and measurement. IAS 32 looks at presentation.
The first one I said IAS 39.
Yes. Then IFRS 7 looks at the disclosure requirements. So these are the three accounting standards relating to.
The 9 is not examinable. The IFRS 9.
What is IFRS 9?
I think they said that one supersedes the 39, 32. Like, I don't know.
Yeah, replacing the
Replacing
two.
of.
Yeah, replacing the two to merge all of these things.
Oh, sorry.
Yes, to replace these two. So the idea is going to be the same thing. So I'm just going to be
the same thing.
Yes, it's the same idea. So I'm just going to be treating them like that. Okay. So 32 is about presentation. 39 recognition measurement. 7 is about disclosures. So let's see how the ideas come together. First, let me talk about IAS 32, presentation. Now, when we talk about presentation, there are three things we need to talk about. One, when to present a financial instrument as a financial liability or equity instrument by the issuing entity. So when do we present a financial instrument as what? A liability or equity? When do we do that? Second, how to separate how to separate and present components of compound financial instruments. Into liability and equity. And then third, presentation of interest, dividends, losses, gains in the financial statement. So that is what we have to understand about the IAS 32. When do we present a financial instrument as an equity? When do we present financial instrument as a liability? When do we present financial instrument interest, dividends, and then losses? Now, when it comes to financial instruments, this is what you have to understand. Anytime there is financial instrument, two things are happening. One, the issuing entity of the financial instrument is on one side, then the entity purchasing the financial instrument is on the other side. The financial instruments, if they are issuing things such as debentures, okay, then the issuing entity, so if it is a debenture, for instance, the issuing entity is going to classify that what? A financial instrument liability. It's a liability. But the entity that is buying the financial instrument of debenture will treat that as an equity, or if you want, an what? Investment. I don't know if you get the idea. So anytime you are standing, there is liability somewhere and there is what? Equity or investment somewhere. So that is the idea about financial instrument. You just flip it up and then the treatment will take. So whatever treatment we will do for the one side, when we flip it up, we will do the opposite treatment for the other side. That is what you have to understand there. Right, so when it comes to the financial instrument, as always, the first thing we want to look at is recognition and measurement. What are the ways through which we can recognize financial instruments? But maybe let's take time and just talk about what a financial instrument is. So what is a financial instrument? Just as I said.
Contract will give rise to a financial asset for one party
and a financial liability to another party. That's it about that. Example of financial instruments. Debentures, I've mentioned it already. Shares, we can talk about that. Loans, investments in debt, trade receivables, all these can be treated as what? Financial instruments. But there are very specialized things of financial instruments called derivatives. And we'll be looking at them in corporate, did I say corporate? In advanced financial management. What are derivatives? And what are some examples you can give me about derivatives?
Swaps.
Currency swaps, currency features, forward, those stuff. These are referred to as what? Derivatives. So we can say that derivatives are contracts that allow entities to speculate on future changes in the market at a relatively low or no initial cost. So these are contracts that allow entities to what? Speculate on the market at low or no initial cost. So as you said, forward contract, currency swap, features, call option, put option, all these are referred to as what? Derivatives financial instruments. Derivative financial instruments. These are usually traded on the stock market or on the derivative market, which is not well developed in the country, in Ghana, but is developed outside the country, and people make investments in that. But how do we recognize financial instruments? So recognition of financial instruments.
So it's meant to be
Yeah, men's gold. Their business is the nature of their business. Yes, it's derivative. We could describe their business as a derivative because it's like put the money there and they make a bet on the market. But it depends. It's complex. Their business is complex. I don't really know their module, so but I think they were classified as derivative investments by the SEC, something like that. So recognition. An entity should recognize a financial asset or liability on its balance sheet when the entities become part of a contractual provisions of the instrument. Listen carefully. So the recognition criteria is that we only recognize a financial asset or a financial liability on our balance sheet when the entity becomes what? A part of the contractual provisions of the instrument rather than when the contract is settled. Get the idea? So immediately we become part of the contractual provisions, we need to what? Recognize. And not when the settlement is done, when money is paid or cash is wired out.
Entity recognizes.
So recognizes financial asset or liability on its balance sheet. When the entity becomes a part of the contractual provisions of the instrument.